Good morning, everyone, and welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, July 30th. Mike Boutros here with you guys. We are just minutes away from the U.S. GDP release. This is the advanced read, guys, for the second quarter. So this can be our first revision, looking for an upward revision from a negative 0.2% read to a 2.5% print annualized for the second quarter. We're just under 2 minutes out. Good to see you guys here. Mark, Chintan, Dale, Depeche. Mark saying useless to hope for a bad GDP number, I guess. Look, I mean, the dollar index, you can see it right behind here, guys. We highlighted this setup. We'll go over this again once the print comes out. But, 12,020 is what invalidated the short side for me. Had the upper median line parallel and a nice pivot in price here. So we've been off the short since this broke. But you're now testing the region on the daily chart that would invalidate or at least validate a more substantial breakout to the upside. So we'll see that in just under 30 seconds here. Looking forward to an exciting webinar today, says Depeche. Good to see you, Depeche. Looking forward to it too, man. Chintan, great to see you as well, my friend. John Daly, been a while. Great to see you, man. All right, so about 30 seconds out. Again, we'll be looking for the annualized quarter-on-quarter print. That's going to be in the main read. You're looking for personal consumption to also show an uptick from 2.1 to 2.7. Not going to really stress the GDP price index or initial jobless claims too much at this point. So this is going to really be the last major data print for the remainder of the month as we wrap things up tomorrow. 15 seconds out. And survey says 2.3, so a little bit weaker than expected. We got a upward revision to the previous print as well, so that might offset some of the losses. Very strong personal consumption reading. This is what you're going to be looking for as well. The Fed's going to like that. 2.9% versus 2.7. Ooh, a downward revision to the previous month, so that might offset that. It's a pretty well-balanced release, guys. GDP core, a little bit stronger on that front, upward revision. I would say it's a broadly balanced print. If anything, it might be a little bit stronger. The upward revisions here, or the upward revision at least in the annualized print, is what's going to be seen as a strong finger, so you might see people dismiss that little bit of a miss on the 0.2 there. Personal consumption, this is what the I think the highlight is going to be. Up 2.9% for the second quarter from a previous read of 1.8. So while the downward revision was 1.8, the stronger than expected read for this quarter, for the revision rather, shows an even stronger build. So broadly speaking, it's a pretty well-balanced to stronger than expected release for the GDP figures. So you're looking at the dollar index here. We are pushing through that 764 retracement yet again. The weekly opening range high was 12,041. So right now you're basically looking for that median line formation as resistance, and that comes in right around 12,055. So let me give you a quick stretch out here and show you what we're looking at. Yeah, it seems like this dollar is just unbeatable right now. So the reversal day close for the year comes in at 12,071. Just ahead of that, I'd be looking at that possibly giving us some resistance, but really the reversal day close is going to be the major resistance that you need to keep in mind for the dollar index. What would put us back on the bearish camp if you do see this thing start to reverse in U.S. trade? You essentially need to get back below that same zone. There was a momentum trigger here that looked like it was giving out earlier in the European trade session. You didn't even get a move below the Asia lows, so there was no play on that front. And the dollar just seems unbeatable here. We'll see if the U.S. opening range pans out, but the crosses that we highlighted yesterday are still in focus. So the euro dollar had a little bit more to go on the travel to the downside. We were looking for support. Looks like we're coming into that region right now. Aussie Kiwi has been a superb trade, guys. One of the only ones that have continued to pan out exceptionally well. Sorry about that. Okay. So let's jump right in. So broadly speaking, I would say, again, this is a broadly balanced to slightly stronger than expected read for the U.S. dollar. Even the core PCE, which is another measure of inflation that the Fed will tend to look at, personal consumption expenditure quarter on quarter coming in 1.8% versus 1.6, even the upward revision there topping estimates. So broadly speaking, stronger data, inline expectation data is kind of what we heard from the Fed yesterday. As far as what we heard yesterday, just to make a quick note on that, the dollar did inevitably rally. The game plan that we talked about here in the webinar right ahead of the release actually, guys, worked pretty well. The move was to fade the dollar. Whatever the initial move was, the play was to fade it. And that's exactly what happened. On the initial stretch on the release, the dollar plummeted into key support. We talked about this yesterday in the webinar at length. 11,985, 11,980, major key support level. On the daily chart, also highlighted by this confluence region here of the median line off the lows and a basic 236 off the lows from June. And that was going to be our near-term bullish invalidation level. Well, it held, okay? And on the initial stretch, like we said, fade the move. Support held, and we went and held right into the highs. It didn't actually break till the close of U.S. trade, and we finally muttered higher into Asia trade. So right now, again, you're seeing flat divergence or flat momentum here as we continue to press into new highs. I'm not really looking to press any new long dollar exposure per se, but keep in mind that we need a pretty compelling reversal here to get conviction to try to pressing some shorts. And the break below 12,020 would be that first initial move, which would be the Asia pack opening range low. So now they have sort of a quick relative picture of what the greenback is doing. We got the data print out of the way. There's no more data on tap, like I said, for the remainder of the day for the United States. Heading into the close of the month tomorrow, the last major release is going to be, or the last release of magnitude I would pay attention to is going to be the University of Michigan sentiment read. This is the final read for July, so I wouldn't put too much emphasis on it. It's just going to be the revision. We are expecting a slight upward bump from 93.3 to 94. Unlikely to cause any major market turmoil or volatility heading into the last day of trade. Look at relative performance for the greenback before we jump into the crosses. Here's what it looks like. You have the dollar strong against all its major counterparts, save the pound, which is up about 0.11%. We'll take a look at that trade as well. I didn't highlight that in the setups yesterday, guys. As I said yesterday in the webinar, guys, when we went over the pound positioning for me is quite precarious here. So I've kind of left my fingers off that completely, but we'll take a look at it. Kiwi dollar, right, completely fell off. 1% down on the session, 1.05 to be exact at this point. So that broke below the invalidation level and the rising median line parallel formation we were looking at, invalidating the long side for that trade. So we'll be looking at that one today as well. All right, let's jump into the trades. As always, guys, if you have any questions, trade setups, feel free to throw them on the message board. First things first. All right, so we'll go over the radar dollar yen chart in just a moment, but let's go over the intraday charts first. So first things first, Aussie Kiwi continues to impress me even. I mean, this thing was giving me a little bit of anxiety just because I was favoring that Kiwi rally. And a Kiwi rally here would really force this thing to break that major key support we were looking at 109.12 into 109.25. Now, that region, again, was defined by the highs that you made here in June. You had the S1 monthly pivot. You had that major slope series that we've been looking at for months now. You had the median line parallel off the highs, and they all coincided right in this region as momentum is coming into 40. So right off the bat, on the 29th here, we started to look for a bounce. We started to look for conditions for some sort of near-term rebound. Guys, does sound okay? Mark, he says it's back. Is sound good, guys? Just want to make sure that we're good on that front. Okay, thanks, Eileen. Appreciate that. Depeche, cheers, mate. So right off the bat, we're looking for conditions. Kyle, cheers. Graham, I appreciate it. We're looking for conditions. We're looking for signals of a reversal, a rebound, if you will, in price, right? Never want to be the one calling the lows. And it's always a difficult process to take underway, but the conditions here and the setup was crystal clear. So the resistance that you're looking for was the former low day close. That's 110.47. We're now trading at 110.24. Here's what the intraday chart looks like for Aussie Key. All right, so last night Here's what we looked at in the scale chart. We were looking at the downward sloping channel that was embedded within this formation. You can see that the low here again came into that key region of support. It was even the channel support as well. So even the embedded formation was coming into support. Momentum was giving some strong divergence. I take that back. It wasn't very strong divergence, but you had a support trigger here which never gave out, and then the break of the resistance. This shifted our buys to the upside. Okay, initial targets 110.16, which was the stretch low for July, or the opening range low, and a basic 236 from the decline takes you to 110.08. Okay, that's where we're trading at right now. We're sort of straddling that region. Shoot, I think we just missed that long trigger. Darn it. I was waiting for that one. Yeah, all right, whatever. Here it is. Here's the 5-minute chart. So here's the opening range for London. Okay, and I just want to show you the triggers that played out in this one last night were really, really clean. So this is the initial break that we would have, the ideal scenario break for the long, right? This was right after the close of U.S. trade, so it wasn't going to be the easiest position to get into. There wasn't much of a trigger break here to ride this on the way up. So, you know, you're not going to ever really catch these guys unless you're right there at your computer. Even if you do, you know, catch the break, the stops become very precarious. Even on a 109.50 entry, you know, a stop at 109.20, you know, that's really pushing it. That's a little more than 30 pips, and you're only looking for about 28. So I can't advocate those types of positions. But Eileen, this is something that you might want to take into account. On the pullback, where do we get in on this position, right? Here's what it looked like on the 5-minute, okay? Here's the breakout. Here's that little pullback. And it's really good on the 5-minute, guys, to bring up this indicator. For those of you who are new to the room, trade sessions indicator, you can get it from MarketScope. We'll highlight the highs and lows for each trade session. But I just wanted to show you this. You had a support trigger, okay, as momentum was coming into a low. Price was coming into the low. You're already bullish, right? Because we just invalidated the short side with this break. So I'm already looking, okay, for long triggers. And on the way down, you have a trigger right here, 3-point trigger, defends the support trigger, and breaks the resistance trigger. Where's your stop? Well, it's against the session lows, right down here. Okay? You're looking at about like a less than a 20 pip stop there. And you're looking for about 30. Well, you would have been, you know, well on your way. So that was the, you know, ideal entry to try to grab the secondary bounce here for the Aussie Kiwi long. From here, I was looking for this 40 to be defended, and that's exactly what we just did. You can see that the London opening range is crystal clear. Here's your London opening range high in green. Here's your London opening range low. Here's momentum defending 40 all day long. And this would have been a decent trigger here to press the long. Again, looking for a target at 110.47. 110.47 is the actual low day close for July. Okay, so the day that the close was made, or the day that the low was made rather, the close of that session, 110.47. That would be your initial topside target there. So Aussie Kiwi, still on the radar, man. I mean, I don't get tired of writing about it just because it's continued to follow the levels so clearly. You know, the triggers are a little tricky just because there's a lot of back and forth on this pair. You can you know, look at the relative performance of the Aussie dollar and the Kiwi dollar in and of themselves, and you can see, you know, you wouldn't be surprised rather to see the cross looking a little bit chopped like this. But the broader levels have been, you know, really clear on this one. So long story short, 110.47 is going to be the low day close. Above that, a 38.2 takes you into 110.78. And this is a region of which I would start to look back to the short side for some possible short entries. And if we go back to the daily chart, you know, basically we're looking at the upper median line parallel there. So that's the game plan, at least for Aussie Kiwi right now. Still favor the longs, looking for a stretch into 110.47, 110.78, 110.80, and you know, we'll curb our appetite up there. Also keep into account that 110.78 level is just above the weekly opening range high, which comes in at 110.72. So the level is just right on, dead on, okay? Um, and dependent on where we are in time, obviously, that median line parallel is where we start to look for possible resistance, possible entry back on the short side for Aussie key. So, Mike, what would make us completely invalidate this? You know, we've been bearish on the Aussie key ever since the reversal last week. You know, what would really make us, get back on the bearish camp here for Aussie near term? Pretty simple, guys. It would be near term, in the immediate term, would be a break below the London lows. Let me bring that 5-minute chart back. So we're sitting and straddling well, this was a targeted region, right? If we break back below 110, especially if the U.S. opening range sets up here and you get a downside trigger, break below 110, momentum makes it back below 40, which even on a 5-minute chart we haven't been able to do since yesterday, okay, early yesterday. You'd look to replay the recovery to the downside and a basic retracement off the highs, or off the lows rather. You'd look to hit that 50,618 region. Okay, if you see a triggered downside break below, like I said, the lows, momentum drops below 40, you see this momentum trigger give out in the 30 chart, you'd look for a targeted region right about here. But the most important thing to keep in mind, guys, is that even if we do see the reversal, and even if we do take the short, you have to trim your expectations coming into this region. This is still key support and will remain so at 109.12, those highs, into the 109.20 zone. So any shorts that we take, anything that we looked for on the short side, as we come into this region, we're going to look to take profits right into here. We'll need to wait for that break, and then we'll look to reassert the short side post that break. That being said, near term, we're still looking for this rally to stretch a little bit higher near that 110.47 level. Any questions on Aussie key? Eileen says, thanks for the extra entry discussion. You're more than welcome, Eileen. Yeah, I thought you'd find that interesting. These are my favorite entries when you have, a support trigger to tell you, let me take a step back. My favorite entries are like this. We're looking for a long, right? But we're playing the pullback. So I want to know where this pullback in momentum is going to invalidate me. So I know that I'm watching for this support to hold, and I have a trigger break. These are going to be my favorite plays because as we come into the lows, and this thing comes into support. You have the trigger break to the downside. You have a threshold of which if momentum invalidates, you already know to drop the trade. And, from this standpoint, the momentum signature has been pretty clear. 40 hold, 60 break, 40 hold, 60 break, 40 hold. Now we're trying to stall a little bit, but 40 has been rock solid support so far still. Okay, so look for a break of the London opening range. Look for a move on the U.S. opening range. Near-term resistance 110.47, 110.78. Okay, so that was Aussie Kiwi. And we will look to track that one just a bit higher in the near term. Next on tap was dollar CAD. And this is another one that you guys, brought up multiple times this week during the webinars. And it seems like the U.S. opening range for dollar CAD has been the play over the last couple of days. So dollar CAD, you remember if we started on, was it on Tuesday's webinar, or I think it was on Monday's Daily FX webinar, we were talking about the median line support and the squeeze below the 2009 high here with a break below this median line really offsetting our bias to the short side. You had the momentum break back below 70. And near term, we were looking for a basic 236 retracement, 2871. That's exactly where this thing found some support. Also, I'll bring your attention to this longer dated median line. It goes a ways back, but it has been pretty effective. Okay, so here's the median line formation we've been following in dollar CAD for, nigh on 3 years now. So support, 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 resistance, resistance, break. Little messy on the upper median line parallel, support. Okay, but on the last couple of pivots on that upper median line parallel, it's been really clean. Despite the fact that we saw it messy earlier in the year, here's the break, here's the tag of support. So I'm still working with that structure. I'm going to leave it on here for now. This thing could see a little bit more upside. Let me show you what the 30-minute chart looks like. This is really the compelling setup. And here's what we were looking at yesterday. As long as we were staying above this median line near term, the focus was still weighted to the long side, but we were looking for that 130.10 level to be, oh, we just stretched into it. The 130.10 level to be near-term resistance. So I'm actually looking for a short here on dollar CAD. Okay, I guess that just happened right now during the release. But I'm actually looking for a short here on dollar CAD, so we'll be looking for some triggers. Some nice divergence in the 5-minute chart. It's not the nicest trigger, but it is there. And the stop is going to have to be pretty far out at this point. So we'll see if we can make another run at that high. We'll see if we can get more little conviction before we head into the U.S. Open. But this is the region of which it would be the near-term bearish invalidation. So if you remember, dollar CAD was on the previous day's scalp report as well, guys. The bearish invalidation was at the weekly opening range high, which is right around 30.45 or so. We dropped that yesterday, the bearish invalidation, down to 130.10, which was a 618 retracement of the weekly range and the upper median line parallel. And that's what you're looking at right here. Here's what it looked like on yesterday's 30-minute. Lost faith in dollar CAD short, says Mark Havermans. Why is that, Mark? Talk to me, man. Haha, maybe that's a good contrarian signal. We do that to ourselves, in fact. Me and Jamie all the time. Because of the dollar strength, he says. Yeah. Look, I mean, the dollar strength story, and no one's saying the dollar strength story isn't warranted. You know, longer term, yeah, and I don't want to beat this story up again. You know, yes, the interest rate expectation, monetary policy divergence will support the dollar, but near term, you know, it seems like it's been a little bit more of an extravagant rally, and the turnaround just won't happen. Keep in mind, Mark, specifically if you're looking at the index, my man, that the CAD is not represented in the Dow Jones FXCM dollar index. So if we're looking at US dollar strength, meaning the Dow Jones FXCM index, which is what you're typing there, CAD is not in that, right? It's Aussie, Kiwi, it's Euro, Aussie, Sterling, and Yen. So keep that in mind. He says, yeah, I know it's not in there. And then Alan says, yeah, man, you want to short something, just let me buy it, and it's a slam dunk, a service I offer my fellow traders. Watch this resistance region. Listen, at the end of the day, guys, you're heading into the last day of trade tomorrow. It's the last day of the month. It's the last day of the week. I tend not to put too much emphasis on intraday price action on these end of month, end of quarter specifically, which it's not, but end of month, end of quarter flows. So I'll be closing my books as of close of U.S. trade today. But that being said, the technicals are the technicals, guys. Don't let all this noise start interfering with our discipline. And that's something that happens a lot when, you know, we go through a rough spot, when we go through a time where, you know, maybe the market just isn't cooperating. We just don't have a clear technical picture. You know, there's a lot of noise in the market, there's a lot of interference from external factors, whether it's event risk or whether it's central bank rhetoric or whether it's something like this, where it throws you off. Don't let that mentality start to filter into our objective way of doing analysis, right? And I don't care if the dollar has gone up, you know, 3,000 days. At the end of the day, dollar CAD's at resistance, period. It could break, but dollar CAD's at resistance. Try not to think about any of this stuff, Mark. Filter all that out of your head. You know, I'm of the mindset where once I get out of a position, win or loss, I try to learn from it. I go back, I review the position, what happened, could I have done something better, was the entry warranted, was the stop well placed. Okay, cool. Once I'm done examining it, it's out of your head. On to better opportunities, on to more opportunities, and the market will always offer that. So just keep that in mind. So a downside move beyond here. You're basically looking for 29.20. I noted this in the report yesterday. 29.20 is what would be needed to shift the focus more advertently back to the downside, looking for 28.70, and then finally a tag at that 1618, which we missed. and that would be 28.45 in the lower median line parallel. If we do crack this upside invalidation level, you know, you're looking back at 131.67. This is big here. This is a big region. All right. Questions on Aussie key, or dollar CAD rather. Also note the divergence here near term for the dollar CAD. Depeche says, question, is it better to wait? Excuse me, guys, my voice is, by the end of the week, is just gone. Is it better to wait for the 30-minute trigger to break and then to look for the 5-minute trigger to break? No, Depeche, no. It's actually the exact opposite, my man. So what we want to do is we want to see the 5-minute trigger break. That's where you actually execute the trade. And then we go to the 30-minute. I want to continue to follow that trade in the 30-minute, and this is what gives me the validation. You know, I'll be watching this one to see the crack, and then great. That kind of gives me the conviction to either maybe take a quarter off the trade if we're at the initial target and hold, or if that momentum holds on the 30-minute, maybe we're all out and we look for a better opportunity. But keep in mind one thing, Depeche, and it's very important to keep this in mind, my man, is that the oscillator, whatever oscillator you're looking at, whether it's RSI, stochastic, CCI, anything, they're all based on the close price for the candle. So Depeche, if you're looking at a 30-minute RSI, this line does not get pegged, okay, or it doesn't get stapled to one spot until the candle closes. So when this price was spiking into 130.20 just now, I bet you RSI looked like it was above 70. And then when it came right back, RSI now looks like it's breaking down. Once this candle closed, that's when this point, reference point, will be pegged. So if you're looking at a 30-minute chart, that's a whole lot of time where you don't know what the momentum signature is doing, right? You don't know where it's going to peg at because it's a 30-minute time span. So that's why we bring it into the 5-minute chart, Depeche. And in this way, you know, I only have to wait for a 5-minute candle to close before I know, okay, it looks like that trigger is in fact giving out. Does that make sense? Crystal, he says. All right. I like that. Yeah, so I think we missed entry on this. I'm going to kick myself for this one later, but in any event, near-term support, look for initial support at the Asia lows and at the European lows. It's 129.60, so a little bit away from where we are right now. Like I said, this is going to be the major key support near-term that you want to look for on the dollar CAD. Right along schedule, guys. I mean, this is sort of risk for more upside near term. Resistance 129.81 backed by the ML 130.10. That's exactly what we just tagged. So this one's kind of been right on focus. This is the bearish invalidation level. You're at the resistance. I think that release we just got with the GDP was the perfect opportunity on this one. All right, any event, we'll get another opportunity once the U.S. Open pans out again, hopefully. Moving right along through yesterday's scalps, last but not least, euro dollar. So this one, I just wanted to highlight this region, 109.24. And despite all the noise and all the chatter, again, we're right there right now. We just tagged it on this release. You're getting some divergence into that low. You had a trigger break in earlier in overnight trade, which gave you a topside pop. Again, didn't clear any highs in price. In fact, the Asia Pac opening range high didn't even get broken on that trigger break. And here's the pullback on U.S. data, divergence into the lows. Excuse me. This for me is the broader bullish invalidation level here for the dollar CAD, for the euro dollar. So let me take a quick step back here and just show you what we were looking at with the euro yesterday. So you saw that daily chart. So we readjusted some of our levels here. If we remember, we were looking at this yesterday before the release to account for new price action, especially using that high as a little bit more of a concrete measure. This is a slope line that Jamie's looking at. I think it actually holds a lot more merit at this point that we've seen this reversal, and we're now testing slope support for the upward slope off of the lows. Okay, So you had a confluence region here of the upper median line parallel and the median line off the lows. And then the lower median line parallel off the lows is catching this right now. It just so happens that this rally, this level right here, is also the exact 618 retracement. So there's a lot to work with here. The Friday low, well, that's 109.24. Today's low so far, 109.22. All right. So if we're going to rebound, this is where we would want to see that start to materialize. For the euro. Bear with me one moment, guys. I just want to tack on some quick extensions. I do want to see if we've completed any major ratios here off the high. Nope. 109.09. And it's way too early to tell, and I'm never going to be an advocate of doing this, but I just do want to see if the levels line up. If we take a retracement, if this turns out to be a low, basically 110 is the only thing we don't have highlighted. 110 and 110.50. Okay. So I'll put a soft target here, just at 110, the big handle, or the big figure. And these would be the levels I'd be looking at if this rebound does materialize into U.S. trade. And again, let's see what the 5-minute chart looks like for the euro here. Again, some nice divergence. Lower low in price, higher low in the oscillator. Looks like an initial rebound here could be underway. Look for a break above 60 in momentum and a break of the U.S. opening range to validate that. Looking for 110, looking for 110.30 on the euro here. 110.30 is the crack I would need to see to really get the validation for the turnaround. But broadly speaking, major key support here near term for the euro dollar. Correlations again, dollar CAD and Kiwi dollar, both commodity currencies, says Mark. They are both considered commodity currencies, Mark, but what's your question there? Are you saying because commodities are showing some sort of rally that's why? I'm not sure what your question is there. So if you're looking at commodities today, it's interesting because you're seeing crude show a little bit more of a push higher. Remember, we highlighted 49.80 into 50 yesterday as crude resistance. So I still think this thing has a little bit more juice to the upside maybe. Gold continues to mutter lower, but we still haven't come near last week's low, which came into a major critical support. So I'm not really interested in playing gold shorts either into the support range. Once we get out the underbelly of it, sure. 1044, 2010 low, 980, 975, huge region of support. But into this region, not really looking for any new short exposure yet. So even on the COM block, I mean, you're seeing some divergences in price action. So I'm not really sure, well, bearish dollar CAD and bearish Kiwi dollar. Right, so there's a divergence right there. He says, I can't get rid of the correlations thoughts in my head. Grr. Yeah, I mean, they can be helpful, Mark, when you're trying to ascertain longer-term trends. If you're looking at weekly charts, monthly charts, and you're trying to draw correlations or conclusions based on that, yeah, when we're doing long-term research pieces or for a writing piece for institutional clients or stuff like that, it's great to have those correlation views in play, right? But on a day-to-day trading, trade in, trade out, it's not going to be something that's going to be as helpful. You know what I mean? So just, I don't want to tell you not to look at that stuff, but I don't want you to take that into account when you're looking to trade on a day-by-day basis. Because there can be a day where, you know, crude is going through the roof and CAD is falling. There could be a day where, crude is falling through the floor and caddy's rallying because the BOC says they're raising rates. So we just want to make sure we're keeping things in account here. Mark, no worries, man. No questions as off topic. Feel free. Okay, so any questions on the euro dollar before we move off? A break below 109.24 pretty much seals the deal for the euro. If that does break lower, you're basically looking at 108.20 into 108.44. That same region that we bottomed into earlier in the month. Keep in mind that the low day close for the month is also in that region. And then we'll be looking for that basic trendline support off the lows. So as it stands right now, my immediate focus right now from the scalping standpoint is against that key support. Okay, I'll still be looking for more long triggers as we open up U.S. trade against this region. If it gives out, or if we don't get any long triggers into the open of U.S. trade, wait for the rebound and we'll look to sell rallies well below 109.30. I want to really caution you guys into the end of the month. It's just, this is the classic time period when you start to get thin liquidity and also, that washout into the close of the month. Things can get really hairy on the intraday type of trading. All right. A question from, I saw someone had on something on Aussie Yen. Who was that? Hey, Dale. Great to see you, man. It says, Mike, can you look at Aussie Yen to the downside? Thanks. Sure. Any questions on dollar or on euro dollar before we move off? So those are the three scalps that we've been following, or at least that I've been following since the FOMC interest rate decision. It was kind of interesting the reaction that the market took, because we really didn't get anything brand new. It was almost an exact copy paste of the previous one. The only thing that really stressed out, or that really irked me, to be quite honest with all of you guys, was the fact that everyone started running with this solid employment gains comment. And if you saw me tweet up a storm for a little bit, which I typically don't do on the fundy side of things, I just felt really compelled to. Why? Because we talked about this right here in the webinar just hours before. The fact that in Humphrey Hawkins' testimony just 2 weeks ago, not even, Yellen was sitting on the stand saying, yeah, the unemployment rate is at the quote-unquote natural running rate of unemployment that the Fed tends to typically look for, but participation rates at a 50-year low, wage pressures continue to remain subdued, and other labor force factors that they're looking at aren't quite as encouraging. So just the fact that they're saying there's solid job growth means nothing. We already know that, right? And we already know out of the dual mandate that inflation is the laggard, not the employment picture. So why the heck are people starting to look at the employment thing as all of a sudden that's what's going to trigger the Fed? No. So for me, I was just, flabbergasted by how everyone ran with that solid number, with that solid comment. In any event, it's not our job to interpret, what the Fed is saying. It's not our job to do any of that. It's our job to trade the markets. And at the end of the day, people took that as broadly saying, yeah, we're still on pace. Bottom line, it's the same exact level for the dollar index that we've been talking about all month long. And while we did close above it by 1 pip on one day here on the 7th, that 12,037, 12,040 mark is still what we need to close above to get the continuation higher. And I will still point out that momentum has still failed to clear 40, or 60 rather, with any type of conviction since the highs that we made in April. So take it for what it's worth, guys, on the dollar. But for you, Dale, yeah, let's take a quick look at Aussie Yen. So here's what the daily looks like. The level it keeps continuing to rebound off of is a major longer-term 618 just lower. It's at 88.96. It's basically at the 89 handle. We never quite made it that low, Dale, but I was looking at this yesterday. This actually does constitute some divergence. It's really, really slight, okay, but you can see a slightly lower low and a much, much higher low. And again, when divergence in the momentum signature, one of them is below the extreme and the other one is above the extreme, whether it's on the 30 or whether it's on the 70 sides, those tend to be pretty strong divergent signals. So that being said, yeah, I'm concerned about trying to play the shorts from here, Dale. until you get back below that median line. And daily chart isn't quite as compelling for me. I do like that momentum is coming into resistance, so if you are going to show some sort of stretch or some sort of exhaustion high, this would be the area to do it near term. Let's see what the 30-minute chart says, Dale. Hold on one sec. Okay. So this line that you see here in gray at 90.32 is actually the low day close for the year. And that's been offering some support. One other thing I'd say, Dale, is this. Look at the momentum signature from the low. Break above 60, holding 40 support, 70 break, holding 40 support. So all of this suggests near term that you're not quite done with the upside just yet. What would put me on the bearish camp, or what would make me want to sell rallies in this, Dale, would be a break below the low day close. And then a move sub 40 momentum. In that case, I'd be looking to sell rallies. But right now, this is classic range. I mean, we've been in this range now for almost 3 days, almost 3 sessions. Let's see what the 5-minute says. Well, here's the one thing you do have in your benefit. On the 5-minute chart, you're basically setting up a major or a pretty, I don't want to say major, it's a pretty simple opening range right at support. So specifically with the opening range low being at 90.32, which is the low day close, I would just look for an opening range break for New York to play this one. Dale, it's that simple. Not my favorite setup right now because I just don't like the Aussie, period. On anything, against anything right now. Maybe Sterling Oz, once we finally get the break, will be something I'll be interested in. But I don't like the Aussie pairs at all right now. If you guys notice, the only Aussie pair that I've been writing about is Aussie Kiwi, and that's primarily because I'm treating the Aussie as sort of a stable, just stable sort of slow mutter lower, and everything I'm trading against it is as such. So with the Aussie Kiwi, it's at support. So if Kiwi would have shown a very strong rebound to the upside, that break would have been very substantial. If Aussie Kiwi was at support and Kiwi would have completely broken down, even if Aussie continues to mutter lower, that Kiwi reversal, you see it down 1% today, would have granted us the rebound, and that's what we got. So you have to be really kind of think through the pairs that you're looking to play. I just don't like the Aussie crosses right now, but this is what I would say. I would say watch your step of anything on the short side while above 90.32. At least for the last couple of attempts, you can see that that's been holding pretty strong support. Hey, Dale, does that help? Let me know if there's any specific, anything else specific I can help you on with that Aussie Yen. He says very much. Thanks. Hey, you're more than welcome, man. Cheers. I do like it, and I have been watching it. I just wish we had a little bit more conviction on what was going on with the Aussie. And the yen, by the way, if you guys checked out yesterday's intraday charts, the radar charts had that yen chart. I've had that on the radar charts for the last couple of days. So here was dollar yen right ahead of FOMC. We were sitting on that median line support. And we said, look, heading into the FOMC, this thing is vulnerable, okay? Major key resistance is 124.13 into 124.35. If we break this support, look for a drop into this 38.2, and that's like 122.90, right? Here's what dollar yen looked like yesterday. We rebounded right off that region into key resistance. So 124.13, 124.35. Here's what dollar yen looks like right now. We're pressing it. Do you know what I mean? And that's yen weakness. So if this breaks out, I don't want to be in a long yen position, which would a short Aussie yen, that's what that would be, Dale. It would be a long yen position. So just kind of where I'm thinking right now as far as relative positioning for the yen. Mark says, I really like these webinars. Drawing charts is one thing, but you really help us with interpreting the overall picture. I appreciate that, Mark, and that's our goal. It's very easy for people just to start a service and just shoot out trade ideas, and either you do well or you don't do well, and that's the end of the game. It's in our minds, me and Jamie, it's much more beneficial for us to really walk you through. And we benefit from these too, guys, because during these webinars, we're working things out in our mind as well, putting clarity to sort of the outlook of what we're looking to do with these trades. So, Mark, I appreciate that, and I hope it continues to help you with your trading. All right, so that's dollar yen. I'm looking to see if we close through this today. If we do close through this, I'm looking resumption, guys. Specifically, the 60 break in momentum. If we're able to break above 60 momentum and clear this, look for the upper median line parallel. Comes in around 25.20, I think is what I put on yesterday's report. Did I put the targets to the upside there? No. Okay, so if we do break to the upside, look for the upper median line parallel here, guys. Like I said, it's going to be around 25.20. And then more importantly, the high day close and the 100% measured move for the consolidation break takes you into that 125.70, 125.56 barrier again. Remember, depending on how you measure this consolidation break, the longer standing or the wider stance measured move actually takes you up into that 128 region. So, longer term, sure, still plenty of uproom for dollar yen. Near term, it's at resistance, and we need to see this level clear to favor buying dips in dollar yen. Here's what the 30-minute looks like, by the way. So let me zoom this out real quick. So for the dollar yen, one thing I also wanted to note is this. You see that green line? I don't know if you can tell the colors there. This green line here, this we added early in the week as soon as this thing broke below 123.50. I think it was on Daily Effects webinar as the opening range high. So on its face value, irrespective of what Mike Boutros or anyone else says, on its face value, opening range, you set a low, you tested the opening range high, you did whatever in the meantime. You break the opening range high, you're constructive against a low, looking for a Thursday, Friday high. It's Thursday. So you can punch through here, look for 125, look for that continuation to 125.25, the upper or the median line off the lows there. But this is a pretty big area of near-term resistance for, not even near-term resistance, just straight-up resistance for dollar yen. And I'd be wary of these pre-market breaks, of pre-market ahead of the market open. So typically won't really look to do anything on this one yet. That's why it's on the radar chart. All right, the British pound. I guess we'll look at the sterling real quick, and then we'll go over in the Kiwi because that's obviously the one that was on the radar most front and center yesterday. So here's the sterling. Do not ask me what happened yesterday at the market open when this thing rallied into 56.80 and then came right back. I have no clue what that was about. I did absolutely love the region at which it reversed. I know you guys know that region because we talked about it here at length in the webinar, and that was 156.80 into 156.99. 618 extension off the low, and a 618 retracement off the high. Favorite confluences. We missed, or we never actually went into that region. on the last couple of stretches. Yesterday came right in the heart of it and pulled right off. Momentum isn't giving us any information whatsoever except a slight upside bias here on the daily. Here's the 30-minute chart looks like. So right off the bat, guys, just a quick step back. When we're doing this on the daily chart, there's not really a very strong directional bias. Okay, so you're thinking range, you're thinking consolidations in this types of format. When you bring it into the near-term chart, you keep that in mind. Okay, that the daily chart is not really giving you. You're not in this type of mode. You're not in this type of mode where you're even coming into a 40 or a 60 barrier. You're in no man's land. So here's what the 30-minute chart looks like for sterling. So it's a little messy with the trend lines, but this is the median line formation we started off the week working with. It was messy last week with the break and recovery. It was messy earlier this week with the break and recovery. We added this one on the peak that we made yesterday. And that's sort of what I'm working with right now. It continues to highlight the same region of support at 55.50. It's also the 618 retracement of the range for the rally off last week's low. The rally off the monthly low, also the 38.2 is at 55.50. So this region in general keeps coming in as sort of something to keep an eye on. That being said, I don't have anything here, guys. I don't have anything here. Sterling says censored, or Mark says censored sterling pairs. Yeah, I'm right there with you, Mark. I just don't have anything here, and that's fine. That's fine with me. There's plenty of other areas we can look. There's plenty of other opportunities. I will check it every day, and you better believe I'll keep an eye on it. But no problem trying to force a trade. There's no point. Again, my loose interpretation here is this. It still has a somewhat upside bias. You're seeing momentum really defend ahead of 40 quite well here on the rebounds. And objectively above 155.80, this region here, 155.90 is what you would loosely interpret as the initial opening range high for the week. Came back kind of messy, but defending the opening range high support, defending the opening range high support, defending the opening range high support. That's all I can say about the pound, guys. Maybe if we make it into 56.50, you'd start to look for some resistance near the upper median line parallel. If you get a compelling short trigger break, this was a short trigger break yesterday that looked like it was a compelling signal, didn't give you anything. Momentum still turned ahead of 40. So I'm not really looking to do much here on the pound. Pound yen, Eileen says, wish I would have minded pound yen. Pound yen, as I said to you guys earlier, is still sort of, I'd rather play pound yen than pound dollar. Specifically, if dollar yen is finally able to make that breakout, and we are able to continue or the resumption of the yen weakness story. So yesterday we were talking about this. We broke back above 192.36, which was the monthly open, and that coincided with the monthly pivot. That shifted the focus back to the upside. Momentum did give you that barrier break, trigger break to the upside as well down here. So the shift focus to the upside, looking for the basic trendline resistance. Didn't clear through it on a closed basis yesterday. Here we are again making a run at 94.43, which is not only the high day close, but also the reversal day close. So high day reversal close. But in any event, nice resistance level here. Keep in mind, to actually fill the gap, the uncovered gap that we made here on the 29th, we would actually need a rally into 94.95 right there. So we might make a break there and push through there. Momentum coming to 60, price at resistance. Here's what pound yen looks like on the intraday. Actually, I don't know if this is updated, so bear with me. Yeah, it's updated. It's just that we don't have any levels beyond here if it breaks. So when it does break, 94.94, yep, 195.86 is the actual high. Yeah, in my opinion, Eileen, you're absolutely right. A little bit more, way more. I wouldn't even say a little bit, way more of a cleaner picture here on pound yen. Again, I don't like to play these exhaustion trades or these well-developed trends for the week into the close on Friday on the end of the month. So I'm very likely, I can't really advocate taking fresh longs from here. From a scalping standpoint, if you do see a tight opening range break to the upside, sure. A stop against that low, if you're willing to take such a move, sure, that would make sense. If it breaks, go up into 94.95. But keep in mind that as long as this thing's in overbought territory, the propensity for it to keep going is there. So if we do open the U.S. session with that thing in overbought, and you do see that push through 94.40, it could very well make that run for us. Just keep in mind, you'd be buying at the weekly high, which is still a difficult feat for anyone. I like it though. I like it though, especially if we pop through here. Looks pretty good. Much better than sterling dollar, at least in my opinion. Andrew says it's been this month has been bad. We are ready to get some pips back, and we will, Andrew. Don't worry about it, man. It happens in every trading strategy. You get rough spots. It's not been hard just for us. It's been hard for everyone. And it's just the roughest trading conditions. And you have to keep in mind again, there's so much going on out there, and so many external factors that the market's trying to digest. The first interest rate hike in 6, 7 years. The concerns about what's going on in China, I think that story is still going to blow up, to be honest with you. Do we have anyone here in the room on China mainland? I would really love to get an idea of what the sentiment is there on the ground. I have a couple of colleagues who are on mainland, and we were just talking yesterday on IM, and I was asking them, what's the sentiment? Is it more fear? Is it more anger? I mean, what are you gauging? And his comments it's just disappointment. A lot of people, vested a lot of their life savings, a lot of their wealth into equities based on the promise, essentially, that this was a government-backed rally. And not only that, the biggest disasters, and a lot of these people were pushed into leveraged assets, so that when the market corrected, it's not like you're holding a stock and if the value goes down to $1, it comes back to $10, you make your money back. No. When the market corrected 30%, these positions got liquidated. So even if the market reverses back up, they're no longer in those positions, right? They're done. So there's a lot of concern about the damage that's already been done. It doesn't matter if they come in right now and they flood the market and prop the equities back up. There's been some serious damage done. So it's going to be interesting to see how this all pans out. I'm not meaning to to digress from the question, Andrew. We will get back on track. The conditions will continue to improve as we get closer to September calendar month and the return of major liquidity, and hopefully we get back some more of this volatility and clarity in some of these major key markets. So that is sterling yen. Any other questions? Who asked about sterling Oz earlier? Was there someone here who asked about it? It's been, yeah, Chintan, 100%, man. I got you. Can you look at sterling Oz as well along with it, Mike? Sure. So sterling Oz looks like this, man. It's a chart that we were following from a scalp standpoint for some time, if you guys remember. Wow, it's still pushing higher. This thing is pushed up for 13, I think yesterday, I think this will complete 14 weeks in a row, which has never happened, right, in the history of the sterling Oz. 13 weeks. So that sliding parallel for the formation that we've been in for like a couple of years now, if you see this, right, that sliding parallel finally cracked through it. It was a little messy. Here we are pressing again. I really don't have any targets until 216.90. I believe that's just a soft target or a pivot in price. Oh, that's the low for it's the 2008 opening range low. Okay. And then the 618 retracement from the decline off the 2008 high actually comes in at 222.17. So there is, a lot of room for this thing on the break here. And historically speaking, we just came back to the 50% retracement of that 2008, 2013 range. So we're right back to the mean, essentially. I don't want to necessarily, Chintan, advocate scalping this pair. It's got a 252 pip ATR, so it's a much, much wider range. And for me, if I don't have previous price action to help me dictate near-term targets, I typically won't scalp the pair. I know that kind of leaves out some of the breakout plays, but you have to recognize the strengths of the strategy and the weaknesses of the strategy. And the strengths and the weakness, rather, of the scalping strategy is not going to be in breakouts, right? Breakouts you don't want to necessarily scalp. If you're playing a breakout, you want to be either in a swing type of position or a long or a medium-term buy and hold type of play. You don't want to necessarily scalp a breakout because your stops will need to be a little bit wider, and you want to hold the position inherently a little bit more because it's a breakout, right? Whereas right now, I don't have any near-term targets that I can look to play to the upside because the previous price action I would needs to go back 7-8 years. So that's all I can tell you on this. For this type of setup, I would just be using simple opening ranges on a weekly basis, and I'd be looking to play a little bit more of a swing type setups on Sterling Oz. I don't really think you want to scalp this one. Also, quarter of the daily ATR is about 63 pips, Chintan, so keep that in mind as well. All right. Trust me, as soon as this thing makes a peak or gives us some sort of pullback play where we can, put some scalp targets in there with some conviction, I'll be all over it. And we did have a pretty decent scalp setup on this a few weeks ago. I think it was about a month ago now. But where it stands right now, I mean, I'm basically looking for 216, 216.90 as resistance. Also, the only other thing I've been pointing out is the ongoing divergence in momentum still hasn't broken. So higher high, higher high, higher high, lower high, lower high. Obviously, we don't know yet because the day's not closed, but you get the picture. So on a top side pop there, you'd want to see sort of this trend line break. You'd still look for that target way up at 222.18, 222.17. Key support on this at this point is back down here. Maybe look at EuroCAD next week. Why? What's going on there? Yeah, I actually just adjusted this one yesterday. I think so too. I think you want to give this another day or so. I want to see if the weekly opening or if the weekly what the weekly candle looks like. This was actually a 200% extension of the range of the decline there, which is interesting for me. Which is real interesting for me. So I actually want to see if there's a reaction off this level, this confluence region here, specifically into the close of the week, into the start of next month. It might not be primed yet for a play, but I agree with you, Mark. I think this one's coming at some very interesting levels as well. Guys, did you notice that this thing basically just made a massive yearly opening range? Here's your January open, January high. You stretch into an April low. You just check the yearly high here, and that's all you've done. That's all you've done. So if anything, a break above this is the yearly opening range break, which is clear validation for an upside thrust, and a downside break below near-term support here. You'd play the correction. You'd look for that 200-day moving average, sort of a mean type of target near 139. So there's a lot of possibilities here. Mark, I'm with you on 100% on this one. Euro pound is something that you've been hearing a lot about, just on the back of what's been going on. That looks like it's breaking a near-term lower median line parallel for the formation we've been following here. So watch the close here today as well. That's not the retracement, 6.8 like it is on the euro, but oops. want to highlight, and I did have this done yesterday, I'm not sure why it's not saved, this region. It's not like the 618 like that is the euro, where the euro is testing the 618 right now. This one already broke, right? The 618 confluence with support. Whereas basically the euro dollar is testing that confluence 618 support with slope support right now as we speak, and it looks like it's making a break. 3 minutes into U.S. trade. That means I got to run, guys. Have a great weekend. Don't go anywhere. Remember, as you head into 1 p.m. today, we're going to have Jamie coming on board with his midweek strategy webinar. I want to thank everyone. Listen, if you've had a little bit of a rough week this week, shake it off. Don't worry. We're starting up a new month, new opportunities. Trust me, this thing will settle down, and we're going to get back into our groove. Let us clear out some of this noise and let this summer months get out of our way, and hopefully we'll have a lot more in store as we open up August trade. Best of luck trading, guys, and I'll see you next week. Cheers.